So welcome to the beginner CFD trading webinar. So the first important thing is that we are going to talk about what is trading, how supply and demand affects price, the main differences between trading and investing, understanding the CFD trading basics, what is a CFD, who are the two parties, know all the markets available to trade with CFDs, how gearing acts as a money multiplier with CFDs, how gearing works, shares versus CFDs, disadvantages with trading shares, trading CFDs, advantages and disadvantages. Also, now we're halfway, how to choose your ideal broker, how to open a trading account, know the best chart type and why, how market trends work, the 3 only trading levels, how to close your CFD trade, when to close your CFD trade, the 5 inevitable trading outcomes, and then hopefully we can have some questions and answers. All right, so what is trading? So everybody is familiar with the term trading, but most of us don't really know how to define it, right? But at the end of the day, we've all traded something in our lives. So think about every time you go to the grocery store, you're trading money for goods. Or even this event, you're trading your money for hopefully good service. So basically the term of trading is simply exchanging one item for another. When we talk about trading in the financial markets, it's also a very similar principle. You buy something for one price and sell it for another, hopefully at a higher price. Thus you make a profit, and vice versa if you short sell, which we'll go into later. So why would the value of a market or a company or product or anything go up? Well, the answer is very simple. The value changes due to supply and demand. The more demand there is for something, the more people are willing to pay for it. So when you get into a rise in demand, you'll get an increase in price. So here's a very simple example so that you can understand. Let's say you go and decide to buy an unpolished and old table for 400 Rand. You go to the store and the owner tells you how the table has been in the store for the last 3 years. And at this point, he just wants to get rid of it because demand is pretty much zero. And you believe that you have the tools and the techniques to furnish this table and sell it for 800 Rand. So what you do is you buy the table, you take it to your garage and you start polishing it and cleaning it and until it's in mint condition. And then you take a photo of your table that you've revamped and you put it on Facebook Marketplace. Yes, I am modern. You put it on Facebook Marketplace and you set a starting price at 800 Rand. And now the Facebook users start bidding. So you can see the order requests are popping in. On day 5, you have 100 people wanting to buy this table. The top price in the marketplace is at 5,000 Rand. And you sell the table and you have it delivered by your courier. And what you bought for 400 Rand, you sold for 5,000 Rand, banking a 4,600 Rand profit. So you literally just made 1,150% return on selling your table. So what a trade that was. And yet people are doing this for a living right now online, not only with trading and investing, but as I've mentioned, through Facebook Marketplace and drop shipping and those methods. So the thing is, what is trading? And in my opinion, we can say it's exchanging one item for another for the sake of mutual benefit or to profit from a price movement. Or what I like to say is it is one big auction with different financial markets and products. So here's how supply and demand affects price. As traders, with supply and demand, we will speculate and anticipate the market's price direction first, and then profit in one or two ways. First, we'll either buy low, buy a financial market at a low price, hoping that the price will move up, where you'll sell it at a higher price for a profit, okay? Or buy low, sell high, as the old adage goes. The second way is that you'll sell high or go short a financial market at a high price where you anticipate the price will drop and you'll buy it back at a low price for a profit. Now let's talk a little bit about trading versus investing. So whether you're trading or investing, at the end of the day, there's only three things you can do. You can either buy, sell, or monitor. That's it. Those are the only things you can do. And there are only a few major differences between investing and trading. And let's just go through a little bit of them. With trading, like I said, there aren't really fixed definitions as to what trading is. But what I like to see it is that trading is a short-term venture that you buy and sell within 3 years. After 3 years, it gains capital, gains tax, and it becomes more of an investment. So on the longer term with investing, it's more than 3 years. The frequency with trading is that you'll be taking many more positions in terms of speculation rather than holding for the long term, such as Warren Buffett holding for 25 to 50 years. The risk is also higher with trading because with traders, you look at other type of instruments. So you look at CFDs, futures, spreads, options. In fact, a lot of people in London didn't want to join this event because of the inability to trade CFDs, and so they are trading spreads instead, which gives us a bit of an advantage that we can choose what we want to do. But then people in America, they don't choose to trade spreads or CFDs. They decide to trade options, which is wow, hell's instrument in my opinion. I went through options for about 3 years, and it was just, let me just say, it was a great learning curve. So the analysis with trading, we tend to look at the technical terms for short-term movements, and with investing, we look at the projection analysis, the micro, the macro, the informational elements to make decisions on how it will be affected with the price in the long term. The approach with trading is that we can go long and short because we're speculating the price movements. With investing, we can only buy or go long, but I say that, but I think that in the near future, based on with the increase in interest with technical analysis, we may start getting investing shorts. For example, as what happened with GameStop. If you do have any questions with GameStop, I'm more than happy to help bring clarity. The products also with trading is that there is a greater variety, and we tend to trade normally using derivatives because we want to use products where we can gain more for less. And with investing, we don't want to lose more than our initial investment. So those are the ideas of the differences between trading and investing. Great. And then, like, what I like to say is the big difference between trading and investing, in my opinion, is commitment. So now let's focus on CFD trading. So what is a CFD? A CFD is known as a contract for difference. Okay. It is an unlisted, over-the-counter financial derivative contract between two parties to exchange the price difference of the underlying asset. So let's break that down now. A CFD, contract for difference, is an unlisted, where you don't trade through an exchange, over-the-counter, private dealer or a market maker, financial derivative contract, value from the underlying market, between two parties, the buyer and seller, to exchange the price difference between the opening and closing price of the underlying asset, which is the market that the CFD is based on. Even easier than that, essentially, you'll enter into a contract at one price, close it at another price for profit or loss, depending on the price difference between your entry and exit. Contract for difference. Who are these two parties that we're talking about? Well, it's you and the market maker or the broker. The market maker makes the market prices. They risk their own capital and offer buy and sell quotes, and they create liquidity into the markets, and they take the opposite trade to you. They are completely unbiased. Okay, so when you buy, the market maker sells, and when you sell, the market maker buys. What are the two parties of the CFD buying? Nothing. There is no underlying asset. You can only bet on the direction of the underlying asset. So either you want to go long and you bet that the price is going to go up, or you're going to go short and you're going to bet the price is going to go down. It's as simple as that. And what can you trade with CFDs? Well, you can trade equities, local and international shares. You can trade indices, so the ALSI, the S&P 500, the DAX, the CAC, the NASDAQ, the Tokyo Exchange, the Euronext, the ASX for those in Australia. Currencies, you can trade Forex. You can trade commodities. You can trade cryptocurrencies. Now let's go into gearing versus CFDs. And I know in the multi-trader system program, it wasn't perfect in terms of how I defined gearing, but the explanation was perfect. But now I would like to actually go into the definition. And what I've picked up is that gearing, also known as leverage or margin trading, is a function that allows you to pay a small amount of money in order to gain control and be exposed to a larger sum of money. All right? So that's my definition of what gearing is. So you pay a small amount of money and you'll be exposed to a large amount of money, which means that you'll be exposed to risk. You'll be exposed to greater potential rewards. So more exposure, less deposit. That's basically the summary of gearing. So let's say you go and buy a house for 1 million Rand, and it is very similar to trading CFDs. First, the homeowner most probably won't have the full 1 million Rand to buy the house with one purchase. So instead, they'll sign a bond agreement, they'll make a 10% deposit, and they'll borrow the rest from the bank, okay? And they'll be exposed to the full purchase price of the home. So they've put in their 100,000 Rand and they are exposed to their 1 million Rand house. So basically the gearing calculation is exposure over the initial margin. Okay? Okay. So let's now go into an example. Another thing that I haven't really covered exactly are shares versus CFDs. And, you know, the way to see these events is if you can pick up 2 or 3 very important elements that you can take into your trading, I would consider these events as success. As long as you have the value towards these events, I'm more than happy to continue. So let's start with buying shares with no gearing. And we will use Anglo American because resources have been our star children this, just 1 second. A bit fast, but my note taking is a bit slow, but we'll take a look at the recording. Yes, Henning, yes, I'm so glad you're recording it. And you're also going to get the slides as well. So, but I'm happy to slow down if everybody wants me to slow down a little bit. But now what I want to do is, first I want to talk about Anglo American and why I chose it. Anglo American has been the winning company that I've traded through. I've got 2 trader services, Red Hot Storm Trader through FSP Invest, and I have Multi Trader, which is obviously the premium Multi Trader service. And last year, we just kept taking Anglo American, Anglo Gold, Sasol, Kumba, and we just didn't lose. So resources have been the winning children in the system that I use, and it continues to do so until we see a change in the market. So I have an idea that maybe retailers are going to soon start picking up again. I had a good run for 4 years with retailers, and then since then things just started getting better for resources. But that's the thing about trading, is you got to learn to evolve. Anyway, let me not go ahead. Buying shares. So let's choose Anglo American. The share price is at 580 Rand. Oh, and this is a trade that we actually took in the Premium Multi-Trader service. So for those who are with the Premium Multi-Trader service, hope you joined in and enjoyed the profits and continue to do so. We've had a stellar year this year already with trading, and we're not even at the end of January. So the price was at 580 Rand. The number of shares to buy was 100. So you buy one Anglo share, you'll be exposed to one Anglo share's value. Okay. I will slow down. Okay. Let me say that again. So we are now, take your mind out of derivatives, CFDs, and let's go back into traditional investing. You are a shareholder and you buy one Anglo share. You will be exposed to one Anglo share's value, which means that you'll pay 580 Rand. And please bear in mind, I am not including costs for simplicity's sakes. I really don't want to confuse anyone today. So you pay 580 Rand per share and you'll be exposed to 580 Rand, which is the share's value. Good. So if you buy 100 Anglo shares, you will be exposed to 100 Anglo shares value. It's as simple as that. So you'll pay 58,000 Rand for 100 shares, and you'll be exposed to 58,000 Rand worth of shares. Now we can calculate the gearing. So remember the calculation. Gearing is what you're exposed to divided by what you put in. So exposure divided by initial margin. 58,000 Rand worth of exposure divided by 58,000 Rand of what you put in. So the gearing is 1 to 1. This means there is no gearing or a gearing of 1 times. And with the share example, what we paid is exactly what we're exposed to. Got it? So now we can now talk about buying CFDs and how we incorporate gearing. And we'll keep to Anglo American. So the company is Anglo. The share price is still 580 Rand. The CFD of the company, this is just the name of what the CFD is called. So if we use, for example, one of the brokers that I recommend, Rand Swiss, you'll see that it is AGL, which is the share code for Anglo American, and CFDs. So AGL CFDs. The margin per one CFD is 58 Rand. Now, what you need to know is that margin is the initial deposit or the collateral that you'll pay in order to be exposed to the share price. So when you see the margin per one CFD, this is the initial amount that you're depositing. The number of CFDs that you'll buy is 100. So it's exactly the same as the shares, okay? So if you buy one Anglo CFD, you'll be exposed to one Anglo share's value. Similar to when you buy one Anglo share, you'll be exposed to one Anglo share's value. But if you pay 58 per Anglo American CFD, you'll be exposed to 580 Rand. If you buy 100 Anglo CFDs, you'll be exposed to 100 Anglo shares value. So you'll pay 5,800 Rand for 100 CFDs, and you'll be exposed to 58,000 Rand. Cool. So now we can do the calculation for gearing. What you're exposed to divided by what you put in. So because you bought 100 CFDs and you paid 58 Rand, it means that what you put in is you times that together, and you'll see that you'll pay 5,800 Rand initial deposit in order to be exposed to 58,000 Rand, which is the share price times by the number of CFDs or the number of shares you would like exposure to. Therefore, the gearing is 10 times. You put in 10 times less for CFDs and you gain the full exposure of the shares. Or in other ways of saying this, you pay 5,800 Rand worth of Anglo-American CFDs in order to gain exposure to 58,000 Rand worth of Anglo CFDs or 100 Anglo shares. So with a gearing of 10 times, for every one CFD you buy for 58 Rand per CFD, you'll be exposed to 10 times more, or the value of one AGL limited share. For every 1 cent the share price rises or falls, you'll gain or lose 10 cents. And that's where I was talking about the reward will be 10 times more per cent movement, but it can also be 10 times less in terms of the risk per cent movement. And that's why you need to know how to trade CFDs and trade in general in order to protect your portfolio and never blow it. Very important. How did I pick up this 58 Rand per CFD? This entirely depends on your broker. They just choose their own numbers based on their own costs and the suffix rates and the CFD rates. So you need to find out on your trading platform or ask your broker for the margin percentage per CFD. Okay. So now that you understand how gearing works, let's look at a trade in action with shares versus CFDs. Example 1. Thank you, moderator. Example 1 with buying shares. So let's say you want to buy 100 shares. You buy them at 580 Rand per share. Okay. So you'll pay 58,000 Rand. 100 shares of Anglo-American times by 580 Rand per share gives you the exposure at 8,000 Rand. 3 months later, the share price rallies. And remember, this is a trade we took recently, very recently, actually. So we now want to sell our full exposure or our full number of shares at 700 Rand per share. So we will receive 70,000 Rand, okay? And we'll profit 12,000 Rand. And why is that? Because we put in 58,000 Rand. So we don't just put 70,000, well, we do put 70,000 Rand into our bank, but we put in the 58,000 Rand that we put in the beginning, and we bank a profit of 12,000 Rand. So let me say that again, because I do know I tend to go a bit fast. You bought 100 shares at 580 Rand. You paid 58,000 Rand. The price then over time went up and down, and it does a zigzag as it does, and then it hit your take profit, or you sold it at 700 Rand. You sold all your shares at 700 Rand per share, and you received 70,000 Rand, which means you got your 58,000 Rand back, and you profited or pocketed the difference of 12,000 Rand. Here are the disadvantages with trading shares. First of all, you had to pay the full 58,000 Rand. You had to just cough it up just to bank your 12,000 Rand. There are so many costs involved with shares, and they still haven't reduced them. You got to pay straight. You got to pay security taxes. You got to pay VAT. You got to pay IPL. You got to pay settlement and clearing. The brokerage is generally tends to be higher, and the gearing is only 1-to-1. Also, the market normally with investing with shares is that you can only profit from a rising market. And the opportunity cost is that there are many other trades that you would like to take, but you had to put in a huge amount of money just to be exposed to one position. Now let's go into the example of buying CFDs. Exact same example. So Anglo-American, the share price is at 580 Rand. The margin per CFD, according to your broker or market maker, is 58 Rand per CFD. Okay. So you want to buy 100 CFDs. You want to be exposed to 100 shares worth of Anglo-American, but not pay that full amount. So you buy it at 580 Rand. You pay 58 Rand per CFD, and you buy 100 of those, which means you pay a total of 5,800 Rand. Your entry exposure is still 58,000 Rand. Remember, your one CFD will give you exposure of one share. 100 CFDs will give you exposure of 100 shares. So 100 times by 580 gives you your entry exposure. But what you initially pay is with the margin, 58 Rand times by 100. So you will pay 5,800 Rand for 100 CFDs, and you'll gain entry exposure to 58,000 Rand worth of shares. 3 months later, you want to sell your position at 700 Rand. So the share price is now 700 Rand. You sell 100 CFDs at 700 Rand per share. So the exit exposure is 70,000 Rand, and you still profit 12,000 Rand. Okay. So notice what I did here. To calculate the profits of your CFD position, you use what you're exposed to rather than what you put in. Does that make sense? So if your entry exposure was 58,000 Rand and you only put in 5,800 Rand, and your exit exposure is 70,000 Rand, you've got to subtract what you are at the end exposed to from what you initially were exposed to, and then you'll profit the difference. I know it's a lot to take in, but just remember one thing. Exposure is where you can calculate your profits. Exposure is also where you can calculate your loss. Because if it went against you, then obviously the entry exposure would be a lot less. Your exit exposure will be a lot less, right? Note, if you want to know how many CFDs you'll need to buy, you'll base this on your money management rules. So as you know, we bought 100 CFDs. Why did we buy 100 CFDs? Did it match your portfolio? These are very important questions to fit your own portfolio. So let's now talk about the trading CFDs advantages and disadvantages. The first thing is that, as I mentioned before, you don't have to pay securities transfer tax, stamp duty, settlement and clearing fees, investor protection levy, VATs, and straight. Okay. So when we're talking about the costs, and this is another thing that isn't in the multi-trader system program, because I did want to just get to the point. When we're talking about the costs, we're talking about the brokerage with CFDs. So you will pay a fraction of the underlying market margin. For example, the average brokerage that you'll pay on CFDs, from what I know today, is 0.2% to 0.6% of exposure. All right, awesome. Thank you. Thanks for letting me know. Your communication is everything with this presentation. So the average brokerage leg in, which means of what you'll pay with the brokerage when you get into your trade, is should be around 0.2% to 0.6% of your exposure per entry leg in. If it is more, your broker is ripping you off. And if it is less, well, you're very lucky, or the broker has some type of way to make their money otherwise. Maybe, I don't know. And then obviously when you get out of your trade, you're also going to pay an average of 0.2% or 0.6% of whatever your exposure is when you get out of your trade. Okay. So let's do an example, bring back our lovely Anglo-American. So the brokerage leg in is the exposure in of your CFD trade times by your broker rates. So remember the exposure of your CFD trade. Notice I'm saying exposure in. So it's your entry exposure. You gained 58,000 Rand worth of exposure. And we're talking CFDs now. And you paid 5,800 Rand to gain exposure of 58,000 Rand. And you had to pay a broker rate of 0.3%, which we'll use that as the brokerage in this case. So you paid 174 Rand to get into your trade. Cool? Then remember the market went up and it went to 700 Rand per share. So now you're going to calculate your exposure out of your CFD trade, or your exit exposure, times by your broker rate. In this case, the exposure out is 70,000 Rand. So remember 100 shares times by the exit price, which is 700 Rand, times by your broker rate, which is 0.3%. And you pay 210 Rand to get out of your trade. So when you, I don't want to go into too much detail, but when you get into your CFD trade, the level to break even will be a little bit higher than the price you got in. And those are the things that you have to consider when we move our stop losses with the premium multi-trader service, so that we can profit instead of just break even. We always want to make a little bit of money to help with our win rates and our winning percentage. So the total brokerage is 174 Rand plus 210 Rand, which is 384 Rand. Note, if the minimum brokerage per trade is 100 Rand, you'll pay 100 Rand. That is another thing that is quite important with trading, because if you say, I'm only going to pay 0.3% of the exposure in, and if that value is less than 100 Rand, you're going to pay 100 Rand regardless. But find out what your minimum brokerage is. Then we have the daily interest finance charges, rather, where you'll go long or buy CFDs, you'll pay daily interest. When you short or sell CFDs, you'll receive daily interest, which is pretty much negligible. But like I said, I want to go through all of the semantics with CFDs. So we'll look at the SAFI, which is the South African exchange yield. And the overnight floating interest rate is 3% per year. Just, I think, 4 years ago, it was 5.5%. So now it is really negligible. The broker also normally charges an additional 2% fee. Okay? So normally 3% is additional annual charge from a broker. So we'll go long and we'll take that 3% that the broker's charging you, plus the 3.31%, which is the interest rate, which means that you will, if you are holding a CFD position, you will pay 6.31% per year. Okay. So if you do become an investor of holding long-term CFDs, which I feel like I am doing with Vodacom at the moment, it's just, it hasn't hit my stop loss, hasn't hit my take profit, it's just been moving sideways. But you know what? The value of it is decreasing. And we needed to go even higher to break even, because every single day we are paying 0.017%. Okay? And in 1 year, if I hold Vodacom, I'm going to pay the full 6.31%. The short is that if you short sell or short a position, you'll receive 0.31% per year. Talk about negligible. So it's the 3.31% interest rate minus the annual charge from the broker. So basically, you'll receive 0.00064% per day. Okay. Don't think you're going to get rich with that technique. The other advantage is that you can buy low, sell high, and you can sell high and buy low. You can get paid dividends. So when you long or buy, you are entitled to the full amount of the dividends. You also have access to world markets. Okay. So you can trade the world, local and international shares, commodities, currencies, indices, weather futures. You can trade cryptocurrencies. You can profit from more with less. And remember, that comes with gearing. The cons is that there are magnified losses with trading CFDs. It's a double-edged sword. If you are in a good position and the market goes for you, you will gain more than what you would with shares. If it goes against you, you'll lose more than what you would with shares. And the other thing is that you can lose a lot more than what you put in. And if the market really goes against you, you can blow your portfolio. Commitment is another thing. Commitment for a trader is a lot more. So as an intraday trader, which I know a couple of people on this forum are, they need to spend a couple of hours a day looking at their screens. A position trader spends around 30 minutes per week, and that includes me. I spend about 30 minutes per week trading. I wait for the trades to line up. I look at the markets. I go through the watch list, and it all requires 30 minutes. Sometimes if I want to write an article or do an analysis, then it takes me longer, but that's not got to do with trading. That's got to do with helping others understand the markets. The other thing is that there's no privileges with shares, with CFDs. You can't vote and you can't attend AGMs because you're not getting anything. You're not getting a certificate saying, congratulations, you're an owner of Anglo-American CFDs. It doesn't work like that. You're just gaining exposure, but they have no idea who you are. The other thing is that you have to pay dividends. So when you short and sell, you have to pay the portion of the dividends that you receive. So make sure that if you hold a very large position, be careful because when dividend days come, it's going to reflect onto your portfolio. And then we have market risks. The market risk is that there's a lot of volatility with trading. There can be company suspensions where the companies can close while you're in your position and it can liquidate. And this is very important, which is why you shouldn't really look for those type of underdog shares or underdog companies that are going to blow up, because these are the ones that have the highest risk at being suspended and being liquidated. You need to consider that your portfolio is always at risk as soon as you put money into the market, and you want to be in a safe position. You want to short companies that are blue chips, that are top companies, and not companies that are near bankruptcy. And I'm sure that is a big lesson that we've learned over the last week. There are also potential wars, crises, war crises, and other wars. So what other war are we talking about now? Pandemics. We now have to consider that there are market risks based on health crises and wars that are taking place in the world. The fundamental analysis of trading is changing because we have other external factors to take in other than politics, economics. We now have to consider geopolitics. We have to consider health crises. And these are clearly affecting markets. And what about social media? Social media is now affecting markets at new levels, not only with Trump's tweets and Elon Musk's tweets, but what happened with GameStop and what happened with the Reddit community who went against the big boys and smart money. These are ever evolving things that we've never seen in our lives. And what a time to be alive to learn these things. And then we have the fat finger, which I haven't seen in a couple of years. But a fat finger is where a hedge fund puts a couple of extra zeros when buying a market or selling or short selling a couple of market. He just has this fat finger and he's just a couple of zeros and he goes buy or sell, goes into the market, freaks all of the share traders and CFD traders and the Reddit communities, and then they start buying and selling based on what is going on with this company, what is happening, when it was just a mistake. All right, these are the market risks, but I actually haven't seen that in about 2-3 years actually. So maybe they have considered those measures via AI or something. The other market risk is that there are gaps. Clearly, there are gaps. In all markets, even Forex, there are gaps. Gaps is where the market jumps your risk levels and where you can lose more than what you anticipated. So if you put your, if you got into your trade at around this level and you put your stop loss anywhere between these levels, and the market opened at this price, in this case over here, then you would still be in your position incurring a much larger loss than what you anticipated. How do you choose your ideal broker? We can go through this very quickly. The broker needs to be regulated, okay, and authorized. So you need to make sure that when you're joining a top broker, make sure they are FSB licensed, SEC, FCA, MIFID. Check their reviews, ratings, and testimonials. Go onto the website and just take a look at what people have to say. Type Hello Peter. Is Hello Peter only South African? Well, anyway, type Hello Peter and type in the broker, type in names, type in anything really, and just get reviews and ratings from real people. Not bots, not trolls, real people. Make sure they offer education and training. Make sure that they have your best interest, where they want to teach you how to trade, where they want to teach you how to manage your risks. You don't want a broker just saying, all right, so let's go back. So what you got to understand is that you get two types of brokers that want to make money and brokers that want to make money with you at the same time, where there is a win-win situation. If they offer education and training and they help you with money management rules, good. You've got a green light with which broker is available. Is good to choose. And if they just say, I can make you this amount of money a month, or I can make you this percentage, and they're only following this marketing strategy, run for the hills. They do not have your best interest at mind. Look up their trading platform features. All right. So when I started trading 2003, the only charting platform I could ever find was something called London School of Investments, which was pretty good at the time, you know, considering that I was using pen and paper to draw my own charts looking at the newspaper. Nowadays, there are so many trading platforms that are available, including, for example, TradingView. If you type tradingview.com and you go to their charts, you can type in any market, full time, all the time frames. They have all the analysis, they have indicators, live data, you can choose your watch list. They're just so reliable. So make sure you choose a broker according to good, high quality and secured trading platforms and features. And you might think, you know, it's not something you want to consider now because you have a good broker. Trust me, I've been through about 7 different brokers since 2003. Why? Because they just keep getting better and they keep getting better platform features. And the next time when you do join another broker, consider these things. The other thing is the ease of deposits and withdrawals. A broker should never take more than 3 working days for you to get your money back or for you to deposit money into their account. If it does, there are red flags that should be all around saying that why do they need your money? Or why are they not depositing the money into the trading account from your bank account? Have those questions in mind. Safety, security, and legitimacy. All right. Make sure everything is encrypted. Make sure they've won awards. Award-winning brokers. Why do you think I always recommend my 3 or 4 top brokers? I'm happy to say them. Rand Swiss, winning broker. IG Markets, winning broker. Iron FX, Blackstone Futures. These are all incredible brokers that I've had amazing experience with, all of the directors. Check their availability. Instruments. Look at the instruments they have available to trade. The markets, the times, the gearing. The demo account, do they have a trial period for you to try out? But the most important are the instruments and markets. Most brokers offer one or the other type of instruments. Do you want to trade CFDs? Do you want to trade futures? Do you want to trade, I don't know why you would want to trade futures, but yeah, let's not get into that. So do you want to trade CFDs? Do you want to trade spread betting? It's whatever suits you best. You know, do you choose iPhone or Samsung? There is no right and wrong answer. There's only a right or wrong answer for you to choose. The customer support. Do they have live chat, email? Do they have WhatsApp? Do they have Skype? Do they have forums? Do they have these Zoom meetings? Find out all this information. Phone, I mean, we can excuse them nowadays because a lot of people are working from home and they're not allowing phone calls. But a lot of brokers still do. And the costs and fees, which most people look at, but I don't know, you know, when it comes to CFDs, you say, all right, what is the brokerage rate and what are the costs? And take a look at them in comparison, but don't spend weeks and weeks and weeks thinking that it's the costs and fees that's going to make you rich or not. No, it's not. You find a good broker, and sometimes a cheaper broker than another broker is more dangerous because they have got shady business going on. So take a look at their commissions, spreads, but make sure you followed these steps. Cool. How do you open a trading account? Nowadays, it's very easy. You go to the company's website, you look for and click on the registration link where it says open live account, open demo account, start trading now, whatever it is, and then you'll just fill in the required mandates, you'll fill in your details. If they start asking for, you know, to read through the T&Cs, skim through them, all right? I'm telling you this because most people just skip the T&Cs. When it comes to anything where you're depositing, withdrawing money, and there's risks and rewards, just go through them because they will have the information about the withdrawals, the deposits, the minimum amount of money you need, how the demo accounts work. They write that for a reason. Even at MultiTrader, if you go to timonandmulti.com and you go to privacy policy and T's and C's, I've taken it quite seriously to write about what the T's and C's are, even though I have an idea that nobody's going to ever read them. I'm just happy that they're there. Send through your FICA documents to a broker. So these are your ID document or your passport, your proof of residence, you know, your insurance, your utility, the post office. They're accepting pretty much anything nowadays just to prove where you live. Your tax number. Are you an individual? Are you a company? Give, you know, phone size and say, I've forgotten my tax number. Can I have it? Yeah. And then sometimes they request a salary slip. Not all brokers require salary slips, but just have that, you know, just have that ready with your bank statements. And the reason is because I think that there's going to be a lot more security measures taking place in the future. Then you fund your account. So you deposit the money. You can do it via EFT. You might do it through a secured payment system. And once the mandates are filled and FICA documents sent, you've done the DFT, you've done the EFT, then send through the POP, which is your proof of payment, straight to them so that they can get you started and start your trading journey like almost immediately. Know the best chart type and why. All right, so you have your very average chart line. Are there any questions? Let me know in the chats. I'm happy to answer any questions you have. So let's start with the most basic chart type that we learned when we were young, when we were doing business school or any chart basically. Okay, awesome. Thank you. Very important is that there are three main elements to consider with the chart. We have the price, which is always vertical. We have time, which is always horizontal. And the way you can think about it is that time moves forward and it never moves back, but we can always reflect on what has happened in the past. And then we have the movement that takes place in order to do all of the trading analysis. The problem with the line chart is that it doesn't give out enough information. For example, within this point, so we'll say within this point, what happened during the rest of the time that took place? So if we're looking at a 5-minute chart or a 10-minute chart or a daily chart, what happened during the day? We don't know. The only thing that we do see is the closing price, if we do choose the closing price of the line chart. So we're not getting enough information of whether it was a positive move, a negative move. We don't know where it even opened. All we know is where it closed. A market can move up, so we're talking about movements. A market can drop, and a market can move sideways. That is it. The problem with the line chart is that it fails to show the entire market activity, which is the buying and selling prices during the chosen time period. So the solution are candlesticks. So with candlesticks, you have the open price, you have the closing price, you have the high, you have the low, and you have the prices between there, okay? So here's different types of candlesticks. And let me get my awesome because I don't need a flip chart. So let me just quickly choose the color I want. We'll go black. All right, so here is an up candle. And the up candle basically starts off at a point. So let's start off at this point. Ooh, okay, that's the problem with drawing these things. Let's see if I can draw a line. Better. Okay, so this is what a candle starts off with. This is what a candle starts off with at the beginning of so the next time period occurs. Let's say it's a daily chart. 9 o'clock in the morning, Anglo-American starts trading, boom, there is a line. And remember, we have a chart which looks like this, okay? And we have time and we have price. So the time starts as 9 o'clock. And this is where the price opens. Then during the day, the market price goes down. The market price goes up. And then it closes above the open. And what you see here is the market activity or the entire activity that took place within a certain time period, which in this case is daily. And there's the green. The green tells you that it was an up candle. All right. So a few things we got to take into account, and that is the open. We have a wick. So the wick is basically what every candle has, and it's between the it's not between the open and the close of the candle. So it's actually between the high and the open is what you'll see with the wick. Then you have the market activity, which moved to a high price, which is here. And then you have the closing price, and anywhere between the high and the close is another wick. We can say the upper wick. And here we have the lower wick. And between the closing price and the open price, we have the body. So this is the body of the candle. This is the wick of the candle. And what tells you that it was an up candle? One, the open price is lower than the closing price. And second, the color. And the color in this case is green. All right. Awesome. Then we have the next candle, which is a down candle or a bearish candle. All right. So this is an up candle or a bullish candle. And this one is a down candle or a bearish candle. Okay. And basically, this is where the next candle opens. So it opens at a point. And we'll say that this is where the open is. So here's the open. The candle, the price movement during the time period then moved up and it moved down and it moved to a low. And then it closed below the open. And here's your wick, your lower wick, and you have your upper wick. Very easy. And between the open and close gives you your body. And the body tells you whether it was an up or down candle, depending on the color. And in this case, the color is red, which means that it was a down candle or bearish. Easy. And then finally, we have the doji. The doji is basically where there is no body. So it's where the open price occurs at a time, and then the market activity goes up to a high, goes down to a low, and then closes by the closes where the open took place. So it's where neither the bulls nor the bears won. Okay. So the doji has no body. There is the open is equal to the close, right? And what else can we say? It doesn't necessarily need a wick. That's the other thing, is that these candles don't necessarily need wicks. If this green candle or up candle did not have a wick and the price opened, which was the low, and then it closed at the high, then this candle would not require a wick. Same with the doji sometimes. And what I mean by sometimes is on a lower time frame, like let's say tick or second time frames, the open takes place and then closes, and then the next market opens. And that's why I'm sure you've seen many times where the markets do this on on low time frames, such as seconds or ticks. And now you know why. Because the open was equal to the close, and then it took place. And this does not necessarily mean that there's no volatility. But if it was, for example, a daily candle, and you saw this take place, red flags should be kicking in, because you should not be choosing markets that do not have any volatility, and you should not choose markets that do not have any trading volume within the day. All right. So that is the that's how it works. So you have your up candle, your down candle, your doji, and that's how it works. Right. So we've spoken about that. We've spoken about the doji. The open price is equal to the closing price, the upper wick, the lower wick, no body, no color. The three only trend lines when trading. So you get an uptrend, and an uptrend line is basically a line drawn from the low prices up to the high prices. There is a positive slope. So there's high and low prices using both the body and the wicks of the candle. All right. So the question that we get asked is, how do you draw the line? Do you draw it from the bottom of the wicks? Do you draw it from the bottom of the candles? And I guess it's through your own statistical analysis of what works best for you. Through the years, what I've picked up is that sometimes choosing the low of the wicks does not work. For example, if I drew a line like this, does that necessarily mean that this is a strong uptrend? I would say no. And the reason is because maybe some guy fat-fingered or just managed to get the price at very low volume at this level, and then the market just shot back up to its average or normal levels. So I do not use the bottom of the wicks generally. I also don't use the bottom of the candles. And the reason is because if I did that, we wouldn't get a smooth uptrend, if you can understand what I'm doing here. So what would you choose when drawing an uptrend? Well, I will incorporate both. I'll incorporate between the wicks. I'll incorporate between the lower parts of the candles. And I'll use both the body, which is the bottom of the candle, and the wicks. And where most of the activity takes place within the uptrend, that is where I will draw it. All right. Then we have with the uptrend is that there has to be higher lows. And using both the body and wicks again, we can see that in this case, there are higher lows. So, because some people say that the uptrend needs higher highs. Yes and no. I would more look at the higher lows. And the reason is because sometimes, why did you not draw through the middle of the green? Okay, good question. And the drawing the middle of the green does not make it an uptrend line. It makes it a regression line. A regression line is basically the activity that takes place on average between the highs and the lows. And this gives you not a uptrend line, but it gives you an uptrend channel. And what the thing is, you can't base your stop losses on a regression channel. What you can do with a regression channel is see what the majority of the what the trend is. Remember, we're talking about 3 types of trends. So if you draw through the green lines, you're basically grabbing the average between the high and the low, and you're looking at the regression uptrend channel. With the uptrend line, we as traders are trying to choose good levels for support. And also we're trying to choose good levels for a stop loss. So for example, let's say the market goes up, bounces, goes up again and bounces. And then we want to get in because we now clearly have confirmed that there has been an uptrend, right? So what we'll do is we will go long a position and we'll set our stop loss below the uptrend. And why would we do that? Well, the thing is that if the market does break through, it wouldn't be in an uptrend anymore. It would be in a downtrend. And if it hits a stop loss, well, the reason why I put a stop loss there is because now it has a higher probability that the market will continue to drop. Okay? And that's why I choose uptrend lines, because these are good levels to decide where your stop loss will be. Excellent. Good question. Thank you very much. All right. The other thing with the uptrend is that there needs to be connected with 3 low points at least. If there are just 2 points, it doesn't necessarily mean it is an uptrend. It could come back down and form a new type of shape. For example, a rounding bottom, rounding top, a double top, an inverse cup and handle, but we don't need to go into that. You know, that's not the point of today. Today is complete beginner, and then we'll go into strategy later. So 3 points tell you that the general trend is up. More than 3 points is always a little stronger, but you don't want so many points that there are, you know, hundreds of points up, and then the market is starting to fatigue around the uptrend. So you want to grab the uptrend pretty much during the accumulation phase. So as you know, and I'm digressing again, is that the markets have different ways of movement. It has a trough, it has accumulation, it has growth, and then it has distribution, and then it has decline. All right. And as traders, we are not interested in this. We are interested in getting at this point between accumulation, ride it up with growth, and then get out before the distribution. The downtrend line is basically the opposite. It is where there is a negative slope. We are using both the wicks and the body of the top of the candle. So we're using both to decide where good points are when it comes to going short a position, or short selling, where you sell high and you buy low. So if we got in at this level, let me get my pen out again. If we saw that there was 1.2 points, let's consider that 3 points, and then we get in at this point to go short, we know that if we put our stop loss anywhere above here, we'll have a good chance that the price will continue down where we can profit. And if the price breaks up, we know that now it has entered into a new potential uptrend, or where there will be a shift from a bear market to a bull market. So I'm happy to put my stop loss at this level. The other thing is that we have to connect at least 3 points, so very similar to the uptrend. And then we have the sideways trend line. The sideways trend line is where there are the same lows and the same highs, all right? Notice that I have used a sideways, or they call this a range-bounded trend, where there is no, let me just get my annotation. Can someone just send me a message? Can you see my cursor? That's another thing I wanted to know, is if you can see my cursor, because I am using my cursor a lot. So with the sideways trend line, oh, thank you. Oh, brilliant. All right, excellent. Thank you. So with the sideways trend line, I will go back to Sam. With the sideways trend line, this is also quite a good opportunity to place a regression channel. And a regression channel will show you that there is sideways movement, which confirms the trend. The sideways trend line is a little bit different. You know that it's in a sideways trend because you have eyes, okay? But more importantly, you want to place a resistance level. Let me write this down, because I want you to know that a resistance is equal to a ceiling level, as I like to say to those who have just started trading, which is also to a neckline, which is used for a couple of breakout patterns, which is also known as a brim level. These are all synonymous, okay? Similar to a support level, which is a support line, is equal to a floor line, which is equal to a neckline. It's still a neckline, and it is equal to a brim level. Yes. All right. So those are all synonymous. So if you ever see me use one of these terms, it's because we're talking about patterns, or patterns. So in this case, there is a range-bounded pattern that forms, and we'll draw the line between the bodies and the wicks of the candle in order to establish the range that takes place, so that when the price breaks out, we will know exactly where to get in, right? And we'll know where to put our take profit level, and where to put our stop loss. What you'll notice is that I've started to put my stop loss a lot lower than before, just because the dynamics of the markets are changing, where there is a high chance that the market will break out and then come back into the range and then continue up. So I've simply now started to put my stop loss. And by started, I mean in the last 3.5 years. I put my stop loss below the entire formation, because if it breaks below, it enters into a bear market. If it breaks between, it is back into the range-bound markets. So all you got to do is you have to make sure that, where you get in and where you place your stop loss, you're going to be banking a lot more. Very important. Always make sure the reward is more than the risk. Great. So we know that there is a horizontal slope, or a regression channel is sideways. We know that there is parallel horizontal lines forming a rectangle or a sideways formation using both the body and wicks of the candles. And there must be at least 3 touches on the support and the resistance in order to confirm its validity of the pattern. All right, this is just a bit more confirmation and ideas of what it looks like with candles of an uptrend. This is a downtrend. And here is a sideways trend. There are only 3 levels when it comes to trading. There is where you get in, your entry level. There is where you set your risk level, which is your stop loss. If the market moves against you, then please get out of my position at this price in order to save myself from incurring bigger losses. And then you have the take profit level, which is a function or a place of setting a level for when the market has reached to a point where you would like it to go, get out, and then pocket the difference, including the costs. So you have your entry level, your stop loss level, and take profit level. Notice that the entry level and stop loss, the difference between this area, let me just get my, all right. I see I've got this. So the difference between this area, between the entry and the stop loss, is less than what I'm willing to bank, which is going into a bit of a strategy, which will go into the next seminar, all right, a webinar. How to close your CFD trade. I see I have to clear my drawings every time. Okay, so the way to close your CFD trade is that you can reverse your position. So if you buy long, or if you buy a position, the CFD position, or you go long a market CFD, you'll close the trade by selling back the CFDs. If you sell or short a market CFDs, you'll close or cover the trade by buying back the CFDs. When do you close your CFD? Well, if you're trading shares, for example, you can only close your CFD during the market hours that are open. So in South Africa, you'll have between 9 a.m. to 5 p.m. for underlying shares. In America, it is between 3:30 p.m. and this is for you, for GMT +2. This is between 3:30 p.m. and 10:30 p.m. for underlying shares. But this also depends on daylight savings. The UK is generally same as South Africa times, but sometimes there is daylight savings where it's an hour difference. And I think, Richard, you can let us know now what time the market opens your side, and which I think you're, oh no, wait, we're at the same time at the moment, but there is times where it can be an hour later or an hour earlier. I think it's only an hour later. I don't think there is ever a time where it's an hour earlier to us. Okay, and then we have Forex, Indices, and Commodities, which takes place, which is 24/5, which is the spot market. Okay, yeah, so Richard says true. So Forex, Indices, and Commodities, 24/5 spot market. And now we are entering into the times where we have cryptocurrencies. And cryptocurrencies, you can trade 24 hours a day, 7 days a week, depending on the broker, but you have to confirm with your broker. So we are entering into a new realm where we are basing less on the market times and more about on the speculation of where people are trading, what they want to buy. For example, this is a prediction or a projection of where I think trading may go in the near future. And that is, so Anglo-American opens at 9 a.m. and it closes at 5 p.m. for underlying shares, right? But what about during the weekend when something happens in with the dollar, where the dollar weakens more, or where they find a new mine, a new coal mine, or they find new methods for drilling deeper at lower costs, for example? What if there was soon an ability where we'll be able to trade shares and stocks 24 hours a day, 7 days a week. Not shares, but CFDs, where we gain exposure to the markets after hours. And this happens with futures, where we base our future speculations within indices and within commodities. So why have we not been able to have the functionality yet to speculate shares prices during after hours? And why I say that is because I think we do need a bit more security, that if you hold shares or CFDs on Friday, your hands are completely tied until Monday. There can be a complete black swan that spooks the market, and you cannot do anything to protect your positions. So these are the things that I think about at night. All right, so there's 5 inevitable trading outcomes. The first one is that you can break even with your trade. The second one is you can take a small loss or you can take a small gain. And the second thing is you can take a big loss or a big gain. We need to avoid the big loss. That is the only thing that we need to avoid. We should never, ever drop our stop loss more against than where we set our position. Very important. Let me say that again. Let me write that down. Never adjust your stop loss against your position further. Never, ever, ever. This is where you're thinking, maybe I should have dropped my stop loss a bit more. This is going against your strategy. This is the maybes that's kicking in. And this is where you go out of your mechanical way of thinking and you go into more of a subjective way of thinking. But you can adjust your take profits. So if the market is going well up in your favor, so let me draw some lines here. So let's say you get in at this price. You set your stop loss at this price. And you set your take profits at this price. Okay. And the market goes up in your favor. And then you raise your stop loss so that you secure the profit. And then the market continues up here. And then it forms another breakout pattern. And then you're more than happy to raise your stop loss. All right. This just might be the breakthrough that beginner traders today in this webinar could use for the future. And I have incorporated it, and I do incorporate it with Premium Multi-Trader, where we bank more than what we wanted to, believe it or not. So then we'll move our take profit at a high level. We already have our stop loss where we know we'll bank a profit. And basically, we're in the second type of trade, and we're just increasing our profit potential. How awesome is that? We have nothing to lose. We have a potential gain to gain. And all we're doing is raising our take profit. And we can continue doing this as long as the markets continue to move in our favor. We've come to the end of the Multi-Traders event, the beginner CFD trading webinar. Whether you're a novice or an experienced trader, you're about to learn many new tactics you can apply to your trading throughout the Multi-Trader events. So this is an idea of what I want to do with the intermediate CFD webinar. And that is, I want to go into, well, first I'm going to recap the most important beginner CFD trading webinar information that we did today, which is awesome. We then going to set up your charts your way. So I would like to know, sometimes you set up your charts and you don't really want a black background. You want different colors. So we can help you set up your charts. We want to know, what are your trading goals for the year? You're going to need to know how to create your ideal watch list. So, are you only looking at Forex? Would you like to set up a watch list with stocks, indices, commodities? And also, what makes up your ideal watch list? What is the criteria that makes it work perfectly? And I got to tell you, sometimes it can be a tedious and laborious thing to set up your watch list. It took me 2 years to set up my watch list, and I will show you at the next event my entire watch list. You'll know the best times to trade, know exactly how many CFDs to buy or sell in a trade, how to spot a healthy chart from a sick chart, how to make sure your winners outweigh your losses, introduction to breakout trading, and then I will reveal the first trading strategy during the intermediate, which is a risk to reward rule. I touched up on it today, but I do want to go into more detail just because we are entering into, once you go into intermediate, this is where you can start talking strategy and building your trading system around it. I'm sure the question I get asked quite often is, what is the difference between a trading strategy and a trading system? A trading system is, in my mind, a trading system is a criteria that you use to get in and out of your trade. A trading strategy involves a whole bunch of other things. For example, a trading strategy is, how do you create your ideal watch list? How do you choose the best time frames to trade? What markets are you using? What instruments are you using? How do you prepare your mind to take trades? The psychology aspects that takes place. And basically, a strategy consists of all 5 things: markets, methods, money, mind, and miscellaneous. A system contains of, if this happens, then I will do this, and I will set my stop loss here and my take profit here, and I will adjust my stop loss if this criteria takes place. Okay, now if you have a question, now is your time to ask. And wow, we are doing incredible with time. I had no idea. By the way, what I told you is going to take place in the intermediate CFD trading webinar. As I create it and build on it, it's going to evolve more. So it's probably going to involve a lot more aspects. But if you are interested, you have the previous invoices. Just complete your orders and I'll add you onto the list immediately, because I do like that there are 7 to 10 people per event. And if I do get more requests for type of events, then I'm happy to adapt course as well. So right now, if you do have a question, please ask.